What did you make of his general comments about the idea of the bond market doing a little bit of the Fed's work for it?
Well, he was asked about that by David, and he basically said that he thought the rise in bond yields was mostly about a bigger term premium, as opposed to the Fed market expecting a higher path of short-term rates. He basically said if the bond market yields were higher because people were expecting higher shorter rates, then that would put a burden on the Fed to sort of ratify that. But the fact that it's term premium means that financial conditions are tightening without the Fed having to do anything. And so he sort of confirmed the Lori Logan speech earlier this month, where Lori Logan, president of the Dallas Fed, basically said, the bond market's sort of doing some of the job for the Fed.
Does that put them in a more enviable position, or does that actually complicate their job when they go into the next couple of meetings here?
Well, the problem is you don't know where the bond market's going to go.
Well, that's what I'm saying.
And so the term premium could go up now, or it could go up higher, or it could shrink, or the bond yields could move around. So I don't think, I think right now they're a little bit more comfortable because they see this tightening of financial conditions. The speech was actually a pretty optimistic speech about how the economy is performing, because he basically talked about how the labor market was normalizing, wages were coming down, inflation was coming down. The Fed, basically you got the impression that he's pretty comfortable with the level of rates, and the fact that the economy is a little stronger than expected, well, that's a nice problem to have. And the fact that bond yields are a little higher, well, that's actually maybe going to help deal with the fact that growth is a little bit stronger than expected. He also implied that he expected growth to slow in the fourth quarter going into next year. So I think the Fed's on hold until they see whether the economy slows as much as they anticipate or not.
Right. They want to see those rate hikes take effect and really filter through the economy. You mentioned term premium. That's certainly one reason perhaps driving bond yields higher. You also wrote a recent column in which you cite quantitative tightening as a reason for why bond yields are higher. How big a factor is QT relative to the other drivers, higher for longer, increased in supply of treasuries, concern over the marginal buyer?
It's hard to know because we've only run this QT experiment one other time. So we don't have a lot of experience with how powerful QT is in terms of pushing up bond yields. But the whole theory of QE and QT is to influence the long end of the yield curve and to manipulate long-term rates. So we certainly know directionally that QT is going to tend to put upward pressure on bond yields. And really the point of my piece was that this is going to probably continue for quite some time. By my estimates, the Fed's going to do QT for probably another 2 years or so before they get the balance sheet down to the level consistent with banks' underlying demand for reserves. A lot of people in the market are saying, well, when will the Fed stop QT? Not anytime soon. QT is on autopilot. Once they flick the switch, it runs until they get the balance sheet back down to the desired level.
In terms of repercussions of the end of QT, you talk about upward pressure on long-term rates and the term premium, but what do you think might be some of the unintended consequences of the end of QT that perhaps people aren't talking enough about?
Well, one consequence of quantitative tightening is it basically drains liquidity from the system. And this is one reason why bank deposits are going down now, and people who like to focus on the monetary aggregates are getting very concerned because the monetary aggregates are shrinking. Well, they're shrinking because of quantitative tightening. There's nothing to be worried about this because there's still plenty of reserves in the system. The banks aren't short of liquidity, but you'll see bank deposits start to fall. And one of the consequences of that is banks will probably start to be forced to bid a little bit more aggressively for deposits.
Higher deposit rates.
They'll have to start bidding for deposits. Right now, they have more deposits. A lot of the money center banks have more deposits than they know what to do with, and that's why they're not really aggressively bidding for deposits right now.
One thing that he did say that I guess to me alarmed me, but I want to get your take on it, was he brought up the Phillips curve, and sort of unprompted. He was asked a very specific question about unemployment and that inverse relationship that you have between inflation, or at least you're supposed to have, between inflation and unemployment, and he seemed to kind of defend the use, or at least the reading, of the Phillips curve. Did you have that same takeaway?
Well, I think the Fed still does believe that if you drive the labor market too tight, you will have an inflation consequence. You almost have to believe that, because if you don't believe that, then you don't really have a model of inflation. Basically, people think that inflation is a consequence of tightness on resources plus inflation expectations. If you get rid of that first piece and just say inflation depends on inflation expectations, well, then the question is, what does inflation expectations depend on? So you really sort of don't have a coherent model of the inflation process. So I think, yeah, economists believe that the tightness of resource utilization matters. The question is how much and how fast does it show through in terms of inflation. One of the things that benefited the Fed tremendously over the last couple of years is inflation expectations stayed very well anchored. And I think the well anchoring of inflation expectations means that the Phillips curve is flatter than it would otherwise have been.
You're not on the Fed anymore, you're not on the Monetary Committee, but how would you think through the implications of the conflict in the Middle East and what that means for inflation and how you conduct monetary policy?
You know, I think it's really still way too early days to make judgments about that. One thing that Powell said in his remarks is, the Fed takes the world as it is.
Yeah.
So as things evolve in the Middle East, if the news is better or the news is worse, if oil prices are higher, oil prices are lower, the Fed will just take that on board in terms of their assessment of growth and inflation. So I think at this stage, the Fed knows that it's a big risk factor. It creates a lot more uncertainty going forward, but I don't think it's factoring into their near-term monetary policy decisions. We have a whole bunch of other uncertainties too, and we have the UAW strike. We have the end of the student loan holiday. So all these things are creating a lot of questions about how's the economy.
Washington.
Yeah, Washington shut down potentially. And so we really have a lot of questions about how the economy is going to perform in the fourth quarter. He did imply that he did expect the economy to slow. He did acknowledge that third quarter is very strong, but he did basically point to a slowdown in the fourth quarter and into next year. Now, if that doesn't happen, then probably the Fed's got more to do.